I'm here with Professor William Black, an Associate Professor of Economics and Law at the University of Missouri at Kansas City. Bill, great to have you with me this morning.
Thank you.
You have been at previous INET conferences. This is the first time we've actually had you speak, I believe, and we've jokingly said that finally we're allowing the F word, the word that the economists dare not speak, be addressed at this conference. By that I mean fraud. And of course, you've done a lot of work on that, particularly the area of control fraud. So do you want to briefly describe what that's all about?
Sure. Control fraud is what occurs when the person who controls a seemingly legitimate entity uses it as a weapon to defraud. And in the financial sphere, their weapon of choice is accounting, and control frauds cause greater financial losses than all other forms of property crime combined.
Now, you were actually a practitioner in the sense that you were an investigator during the savings and loan crisis. How would you compare the response that we've had post the great financial recession of 2008 to how we dealt with the savings and loans crisis?
Right. So there has been essentially no response from the criminal justice system to the current crisis. There was quite a delayed response to the savings and loan crisis. It was actually helped by congressional actually holding a hearing, a substantive hearing, and saying, you should be actually investigating and making criminal referrals and making a high priority of going after these criminals. So that was Doug Barnard, a former banker, and probably has disappeared from history. But that helped embarrass the agency and the Department of Justice and the FBI into getting very serious. And they created a criminal referral system that in just our agency, which became known as the Office of Thrift Supervision, so this is regulating savings and loans in the heart of the savings and loan debacle, made over 30,000 criminal referrals, eventually produced over 1,000 felony convictions just in cases designated as major. And that really understates the degree of prioritization because we created, with the FBI, in a really serious process, the top 100 list of the worst fraud schemes, which involved 300 savings and loans and roughly 600 individuals. And they were virtually all prosecuted with a 90% conviction rate against the best criminal defense lawyers in the world. So that's the most successful criminal justice response to elite financial frauds in world history. Flash forward to the current crisis, same agency, Office of Thrift Supervision. This crisis is 70 times larger, just in terms of household losses. If you measure it by productivity losses, lost GDP, it's something like 150 times larger than the savings and loan crisis. And that same agency made 0 criminal referrals. It was supposed to regulate Countrywide and Washington Mutual and endemic. These are all massive entities pumping out fraudulent loans literally by the hundreds of thousands and collectively in the millions. So there have been, as we speak, 0 prosecutions. I'm not even talking about successful prosecutions. There have been 0 prosecutions of any of the elite bankers that actually drove the fraud epidemics that caused this crisis. And it isn't just the elites. So if you look at the small mortgage banks, or even fairly large but obscure mortgage banks, these are not the Wall Street guys, they too skated in terms of prosecution. And it isn't just the Office of Thrift Supervision. The Office of the Comptroller of the Currency, which is supposed to regulate national banks, the Federal Reserve, both ceased making criminal referrals, and the FDIC is smart enough to refuse the answer to the question of how many referrals are made.
And the person who has answered this, Eric Holder, the Attorney General, has basically said, well, we haven't found any evidence of fraud or wrongdoing.
Actually, he hasn't said that. He said vague things that can be interpreted sort of kind of that way. But he's never been pinned down. And he has never given that kind of flat answer. What he has said unequivocally, though he backed away from it very quickly, was that the really huge banks were too big to prosecute. And his head of the criminal division, Lanny Brewer, who has since resigned many people would say in disgrace.
He made that point explicitly, I think, on a PBS program dealing with this.
He did, and he
yeah.
also was asked about a prior speech he had given to a bunch of lawyers in New York representing the biggest banks, in which he talked about how he lay unable to sleep at night for fear that he might harm a large bank, which it's hard to see how that fear, since he never did anything to the large banks.
It makes one almost long for Alberto Gonzalez, who I pointed out at least prosecuted the Enron guys, actually.
Well, indeed, there are numbers on all of this, and from the savings and loan days, where most of the prosecutions occurred under the first President Bush, through the Clinton era, and then Bush 2, and now to Obama, there's been a steady decline. And we are at well under half the rate on sort of all elite white-collar crime. So when 9/11 occurred, they transferred over 500 FBI specialists from doing white-collar to doing national security, and national security became literally priorities 1 through 9. So 10 is everything else, and in that list, financial fraud is pretty far down. And since it was their highest priority, of course, they were trying to transfer the absolute best FBI agents out of white collar. And since they knew they couldn't infiltrate Al-Qaeda, they weren't looking for those kinds of FBI specialists. They were looking for folks who could follow the money, as we say. In other words, the most financially sophisticated FBI agents. So they not only took the best agents, but they took the best agents with the skill sets that were critical to dealing with these cases. We're now left with right around 2 FBI agents that do white-collar crime investigations per industry, not per corporation. And of course, banks don't make criminal referrals against their own CEOs. So the only way you're going to get a prosecution, FBI agents, there's 2 per industry. A, they can't have industry expertise, and B, they obviously can't walk a beat or they'd never find anything. So they only go when there's a criminal referral. Criminal referrals have ceased from the regulatory agencies. Banks are not going to make criminal referrals against their own folks. You'll get a few episodically from whistleblowers, but it means that basically there is no system for even beginning to prosecute. Not just the big banks, but the smaller banks for the frauds. And by the time we're speaking, we're getting very near the effective end of the statute of limitations.
There was a proposal, I believe, by Representative Marcy Kaptur to use some government money to hire an additional FBI agent specifically to build up the agency to deal with this kind of a problem. Whatever became of that? Because you wrote about that proposal.
Yeah, and the Congress has gone the opposite direction. The House is in an unholy war, House of Representatives, the United States is in an unholy war against the regulators, the SEC and the Commodities Future Trading Commission in large part. And again, these are the people that have to make the referrals, that have the expertise to allow the FBI and the Justice Department to do anything. They did not allow the FBI to replace the agents who were transferred to national security, and that's been under both the Bush administration and now the Obama administration. This, again, is in sharp contrast to the savings and loan crisis, where Congress passed 2 bills in 1989 and 1991 that mandated dramatic increases in staffing for the FBI and the Justice Department, and mandated that it be used to go after the savings and loan crooks. So I told you that before the 9/11, there were roughly 2,500 FBI agents. In the savings and loan crisis, at peak, we had 1,000 of those agents assigned just to dealing with savings and loan cases. As recently as fiscal year 2007, there was a grand total of 120 FBI agents nationwide dealing with all cases involving the crisis. And they were doing Dick and Mary cases, some homeowner and maybe a real estate broker. They were bragging by 2008 that half of their cases were now $1 million. Well, that's 2 California houses and such. So it's a complete misallocation of resources They haven't even begun to investigate the large institutions. They're unwilling to do so.
And even when they do investigate them, they come to these settlements where they don't really investigate. They pick a number out of midair, it seems, to settle, and it doesn't come anywhere near covering the economic damage.
And two other major aspects along the lines that you're talking about. Of course, the CEO handles the negotiations, and Jamie Dimon famously stepped in personally. Well, what are his interests? His interest is, first, they don't claw back my bonus, that I got massive amounts of money for producing fictional income. And he's happy to trade off a fine, right? And second, of course, the money comes entirely from the institution. The officers who caused the problem control the institution. So they're happy to trade off, we'll take a bigger fine, but you won't prosecute anybody. It's an immense conflict of interest. So the settlement process itself is both a demonstration of the problem and a worsening of the problem that ensures that the elite officers are able to defraud with impunity.
It's a very marked contrast to what we had in the 1930s when Jesse Jones, when he was heading the Reconstruction Finance Corporation, not only did he shut down a number of banks, but he demanded letters of resignation from all of the CEOs, and he put them in his filing cabinet there to be used in the event that he needed to use them.
That's true, and in the savings and loan crisis, we put something like 600 savings and loan in a receivership, got rid of the people, went after them if they engaged in fraud, tried to leave them penniless. In those circumstances, if they engaged in fraud, and made the criminal referrals, and made over 3,000 enforcement actions that were often real, where we were directing at the officer as opposed to at the, what does it pay to go after a bankrupt bank that you're paying for? Anyway, through the insurance fund, there's no real recovery in those circumstances. And the SEC in the modern era gets almost entirely useless consent decrees, and disproportionately it goes after the dead, who are never going to issue a security again, and then all they get is something that says, if we ever issue securities, we will comply with the securities laws. Well, you have to comply with the securities laws anyway, and we're speaking shortly after the longtime SEC enforcement attorney has resigned at his retirement party with his blast, saying that my bosses, A, are afraid to go after the big guys, and B, that they don't want to because of the revolving door, that if you're too vigorous, you hurt your job opportunities. And you can see this in the context of the SEC, where about 20% of their cases on enforcement are just pure fluff. That are created solely for purposes of numbers.
And in fact, people who did their jobs rather too well are unemployable right now. You've mentioned the case of Ed Gray, for example, as one very poignant example.
That's right. Ed Gray was the chairman of the federal agency that regulated savings and loans. He was appointed, he was quite told this by the Industry Trade Association because they believed that he would be friendly and malleable and such, and became the great re-regulator. And that is the primary reason. If we back up a second, when I used to write about the savings and loan crisis and about the savings, I thought they were large, but $1 trillion. But of course, we didn't have the advantage of the current crisis, where people failed to regulate and did the opposite in many ways for over 15 years. If you'd had the same response to the savings and loan debacle, it would have been measured in the many trillions of dollars. Ed Gray began re-regulating 1 year after the federal deregulation bill, the Garn-St. Germain Act of 1982, went into effect. And that was a bipartisan bill with very strong support. So we were opposed in those efforts by the White House, which at one point threatened to make a criminal referral against Ed Gray on the grounds that he was closing too many insolvent savings and loans. Can you imagine that in the modern era?
Actually, I can, sadly.
Well, I can't imagine the regulator getting to the point where he has to be threatened, unfortunately. And he'd take on the leadership of both the Republicans and the Democrats in the House and the Senate. The Speaker of the House, very powerful Speaker Wright, held hostage our bills expressly, trying to extort special benefits for the frauds. The famous 5 U.S. senators became known as the Keating Five. The Trade Association, political scientists in America, called it the third most powerful in the United States of America. And of course, the trade press, the business pages, hated us. The re-regulator was the greatest insult they could muster. We obviously were atavistic idiots that didn't understand modern economics and such. So Ed Gray is unemployed and unemployable, and we're now talking about over 30 years since he's done this. Our top supervisor in Texas, which was our worst place, was forced to resign, and the new head of the agency, Ed Gray's successor, who was appointed to be the anti-Gray, took public credit for it. Now, this is the most distinguished supervisor in America. He had been the former head of the Office of the Comptroller of the Currency on an acting basis as a professional who came up through the ranks over 20 years and then had this incredibly impressive record at the Savings and Loan. And the head of our agency forces him out because Speaker Wright wants him out, claiming that he's a homosexual, sending all the work to homosexual lawyers. Right? I mean, just insane things from that era where lots of people lost their careers entirely because they were willing to do the right thing. And it meant, we now know, savings of many trillions of dollars.
Now, one final question. You have jokingly said that economists don't address the F-word fraud in their own analyses. You, of course, are both an economist and a lawyer, and a criminologist, so you look at these things. Do you think that's changed? And what's been the rationale why economics has dealt so poorly with the issue of fraud?
I don't joke. I make a observation that there is a primitive tribal taboo among economists. So if you go back, classical economics understood fraud and all said that one of the key things that a government has to do is provide a rule of law and a police force and an anti-fraud. Ayn Rand, von Mises, von Hayek said that you had to deal with fraud. Along comes neoclassical economics, standard assumption, information is perfect, cost-free. Well, you can't have fraud in those circumstances. So it would be, to ask an economist, neoclassical economist, about fraud, it would be equivalent to asking a zoologist to tell you about unicorns, right? It can't exist. It's a fictional beast. And such. Law and economics was even worse when it came along, what we call theoclassical economics, where it's a pure religion. So the famous thing that now a generation of lawyers has been taught in America from this treatise that I'm about to quote from, it says, a rule against fraud is not necessary or even particularly important.
Which is, I think, the comment that was made to Brooks Lee Bourne when she went after tried to go after some of the banks
and by Alan Greenspan in their very first meeting, where he said that you and I are clearly going to disagree, which he thought was a fairly strange line to someone you've just met. And he said, you probably think that fraud is a basis for regulation. And, so she got that look you get when you're trapped in an elevator with a crazy person, type of thing. Unfortunately, all the world was trapped with a crazy person who was in charge of the levers at the Federal Reserve. And he proved to completely ignore fraud. And if he hadn't, there wouldn't have been a financial crisis.
Do you think that might change under Janet Yellen, especially given that her husband is George Akerlof?
Well, we've just had a talk that explained that what things that Joe Stiglitz had been saying for 20 years have not been incorporated by neoclassical economics. And the perfect example of something akin to that, of course, is someone who got the Nobel laureate in the same year for similar work, and that's George Akerlof, and Janet Yellen's spouse. And Akerlof explained how this looting occurred, how this fraud mechanism occurred, and the response of the person who is the leading economics textbook writer in America now, in the world actually, and Gregory Mankiw was, and I quote, "It would be irrational for savings and loan executives not to loot."
Unfortunately, that's true, given the fact that he seems to be getting prosecuted this way. And as you pointed out, the best way to rob a bank is to own one in your own book. So.
True, and the title of the Akerlof and Romer paper in 1993 is Looting the Economic Underworld of Bankruptcy for Profit.
Yep.
But Akerlof and Romer and I thought there might be a moral content to this.
Yep.
Mankiw, not so much.
Well, maybe things will change now that we have Ms. Yellen at the head of the Fed. One can hope so. Bill, as always, it's great to speak to you. It's great to see you, and very much appreciate sharing your insights with us this morning.
Thank you for the opportunity.